Unfortunately, Scott, I think we do. I think capitulation hasn't, and I agree with Kev here, I think capitulation hasn't fully ensued yet. If you see it, obviously Apple has been the one that's held it up the best, with the mega cap names, but down 18.5% this month. Microsoft down 12% this month. I mean, these names still need to feel a little bit more pain. And if I'm relating to what Kev is talking about in terms of what is the big event, I think the Fed is the big event. The Fed has to lead the way. They have to do what they need to do from a quantitative tightening perspective. Why? Because inflation is still wild. It is still raging, and it needs to be pulled back. And from the commentary that we heard this week, obviously, the Fed is not terribly concerned about the price movements in the market. They're willing to do the work, and they have to. So I think until they really get going, and they've obviously started, but until they really get going and more volatility ensues, we're not going to see the flushing yet, and where you can really start to leg into some of these names.
I mean, they started to come after the winners, big-time winners this week, Steph, to wonder whether things really did start to change this week, right? The staples. The worst week since March of 2020. The sector itself down 9.5%. Walmart down 19.5%. Costco, which reports next week, down 16.5%. P&G 9%. Coca-Cola, which you sold, 9%. Pepsi down 7.5%. Kraft Heinz down 14%. Target's not technically a staple. It's more of a discretionary, but let's just put it in the group for obvious reasons, down 30% this week. Are you as negative on the near term as Kevin and Jason Snipe certainly appear to be?
Well, it's really disappointing that we can't hold a rally, right? I mean, and this is what bear markets are. And this is what happens when you don't have the Fed as a backstop. So you have multiple contraction. And now this week, I mean, earnings overall for the first quarter, Scott, were pretty good. 12%. We've talked about that, right? But this past week was terrible for earnings. So now you have an earnings question. And I think if you look at the earnings, it wasn't demand, right? Demand actually was pretty good across the board, right? But it was really more margins. It's the supply chain, it's inflation, it's all of those things at higher costs. And that's really eating into profits. And it's disappointing for sure. But I don't think you all of a sudden can conclude that we're headed for a recession. I'm with Kevin, and I've been saying this for a while. I don't think you're going to see a recession this year. Next year is a totally different ball of wax. But this year, I think the fundamentals are still solid. We just have to get through this uncertain period as to where earnings are going to settle out. By the way, back to your question about tech, as long as we have inflation, you're not going to want to have high duration assets. The Fed is going to continue to do their thing, but they're not going to be able to fight inflation. Supply chains are going to help on that inflation front, right? So maybe if inflation comes down a little bit, it's still going to remain elevated. And that's what's the real problem with some of these technology companies, particularly the companies that don't have earnings. And one last thing, tech and comm services is still 35% of the S&P 500, still very overowned. I think you want to be selective and look for companies with strong free cash flow, earnings, and again, valuation discipline.
Some are suggesting that a lot of those stocks that you just talked about, the higher valuation ones, even the ones that have gotten the most creamed, are attractive. And, people you all know, and people our viewers know of, and people on Twitter follow, like Eric Jackson, who told me this in overtime yesterday.
If you asked me 6 months ago, probably my biggest fear was, are some of these names actually going to trade down to the March 2020 pandemic lows? And we've gone way past that with several of these names. We are now in a zone which is, for some of these companies that have been public for maybe 6, 7 years, they've never been as cheap as a public company as they are now.
Now, Kevin O'Leary, if you're a 5-day or a 5-week investor, just put on earmuffs, because I'm not speaking to you at the right for this segment. But if you're a 5-year investor, Jackson's been buying Twilio, which went from 412 to 87. Upstart went from 401 to 25. Okta from 276 to 77. Carvana from 376 to 28. He's been buying all of them. If you're a longer-term investor and you admit to yourself, I don't know exactly where the bottom's going to be, but these stocks are going to do way better over the long period. Why not? Why not do a Jackson?
Well, no, listen, I'm not against the move, but let's say you're going to buy $100 of each of these stocks. I'd only buy 20 right now, a fifth. I just don't think we've seen the bottom yet. And these names can go lower easily, very easily. These speculative names, and many of those names are actually pretty good businesses, but it doesn't mean their PEs can't go down another 10, 15%. And so there's nothing wrong with legging into the market. But if the idea that we've seen the bottom and we still have all these uncertainties out there, we're not there yet. So the only strategy, and for me, it's a 20%. If I'm going to own $100 worth of Carvana, I'm going to buy $20 today. I'm going to put $20 in 30 days, $20 in after another 60, 90 days, because I don't know how to pick the bottom.
Yeah,
and
but you're talking.
I'm really
I'm
unhappy
talking,
without.
You're talking like you're somebody who's got like 75% cash sitting and you have anything but. I mean, you only have 17% cash.